Good morning. My name is Mark Brennan. I'm the Executive Chairman of Ascendant Resources. Ascendant Resources is developing the Lagoa Salgada project in Portugal. It's a multi-metal asset. We've recently completed a feasibility study, and we're looking to bring the mine into construction by the end of the first quarter.
Okay. Well, good to see you again, Mark. I haven't seen you since we spoke, I think, correctly, November 2021 with Cerrado Gold. Are you still with them?
I am indeed. I'm the executive chairman of Ascendant, but I'm the CEO of Cerrado.
Right. Okay. So, but is that where's your focus? Just so I'm clear.
My focus, the reality is that my primary focus is Cerrado, but we have a very strong team at Ascendant, and we are bringing in a new CEO into Ascendant in the near future.
Right. Okay. So you're talking about like getting back into production, and it's in Portugal, it's in Europe, obviously. So, and I want to talk about that, but that's big talk from a $20 million market cap company, and especially off the back of what I think some people in the various chat rooms are talking about is a kind of disappointing feasibility study which came out recently. So how are you going to do it?
Well, I'll say first of all, everything is relative. If we were a $100 million company, the feasibility study would have been disappointing. We were under some time constraint and some time pressure in order to complete the feasibility study, in order to take our ownership from 50% to 80%, and that had a lot of influence in terms of the outcome of the project, in terms of the feasibility study. On the feasibility study itself, it followed on a PEA that we published in September of 21, basically outlining 150 million NPV with 250 million NPV with a 55% IRR after tax. This one's come in at 150 million NPV with a 39% IRR after tax. And the biggest difference that we've seen was inflation. We saw a big drive in terms of inflation, CapEx and OpEx. And where we are now is that because we had to get this report out in a hurry, we really didn't have the opportunity to maximize the greatest scenario for the project. And so as we put out in the press release, our objective here is to start, we're already underway with an optimization program. We expect that to be completed by the end of the year. And from that perspective, we believe that we're going to see the NPVs growing to north of 200 million. And the reality is that we see some very definitive routes to get there. It's not just wishful thinking. It's a very complex deposit. We have two zones. We've got multiple domains. Five. It's a polymetallic, pure polymetallic. So there's 5 products that we're selling, and so that's complex to create a mine sequence and life of mine plan, and we don't feel that we've optimized that sufficiently. But again, we published a feasibility in order to get to our 80%.
Right. Well, let me just ask. Sorry, and I'll get to the kind of polymetallic, the complexities of building out a company with polymetallic deposits in a minute. Let me go back to the kind of 80%, maybe 50% to 80% ownership. Was it never an option to go to the group that you're getting this asset from and saying, look, unusual circumstances, not quite force majeure, in fact, very much self-inflicted by governments. Can you give us a bit more time? Was that not an option for you?
No, it was an option, and we did actually extend it a little bit. But the reality is that it had a cost, and at some point we just decided that cost was just we decided to take our lumps right now. Really important to your point on a $20 million company. We did announce that we have the UK government export credit agency is prepared to fund us on a project funding basis up to $190 million. We also have Sprott Streaming and Royalty, who have agreed to provide us with up to $40 to $50 million of streaming capability. We've also talked to some groups about an offtake. So the point is that what we're looking at is we believe that we can get funding before the end of the first quarter of next year. And our hope is that we can do that with a fairly small amount of equity, but also as we optimize the project and as we provide evidence of our funding, people will give us more value. But this was a very, just to very succinctly, this was a very first target at creating an established product And we feel that again, there'll be another one before the end of the year showing much better value.
Right. Okay. So time constraints meant that you had to put something together to be able to kind of pick up the full 80% position here. Okay. Right. So let's talk about how you persuade people. The fact that you may get debt further down the line from a multitude of sources, and Europe is splashing the cash at the moment. If it's electric, EV metals, the coppers, the nickels, lithiums, etc. In terms of the sorts of options that you've got on the debt, what are people looking to in return for that? Obviously.
Well, what's nice is working with export credit agencies. The general cost of capital will be 5 or 6%. No equity. It's generally tends to be very attractive in terms of rates, and then on top of that, it looks like it'll be 6 to 8 year tenure. So from that regard, it's a wonderful piece of paper.
Right. Okay. So you may get some credit for that further down the line, but you're also going to have to. I think you've indicated that you're going to basically do an update to the feasibility study by the end of the year to see if you can't improve on some of those inflation hit factors. So what were you? You must have been expecting the cost to be significantly more. I mean, given what's happened over the last couple of years.
Well, we didn't. You mentioned Cerrado earlier, and Cerrado actually the cost looked very similar to very small changes to 21. But so we didn't expect.
So where's
it
it
actually.
hit you? So what are the factors that have hit you? Is it
well, I mean, operating costs, fairly dramatic increase in terms of right across the board, and then in terms of capital, just capital. If we look at our the price of the plant, which obviously the most important thing, so very extensive, the fleet, so it was right across the board. But we didn't. And what tends to happen is when you're completing these feasibility studies is when you start getting you complete your design, and then when you get to the factor of financial modeling and life of mine and sequencing, capital, you tend to see capital creep. And things which we don't think necessarily should be there, or certainly to the extent they have been there. But again, we've seen just inflation across the OPEX, across the CAPEX, right across the board.
I mean, it's like, are you nervous at all? Because I was reading sort of RBC report about, I think they analyzed like 150 companies, like building out and getting into production and then ramping up and so forth. And they're saying like 80% of those 150 companies were late and over budget. You must be sort of aware that it's not easy. What you're doing is not easy. Are you looking at the asset and going, is this asset good enough to sustain any delays in time and any further increases in costs? I mean, what's your kind of risk assessment of what you're
I'd say this, this is probably the fourth mine that we're looking to build as a team. And basically, we restructured 3 mines when I was at Sierra. So we have a lot of operational expertise. And so what I'd say to you is, and what I say to everybody, and I should have said a little earlier, this is a discovery asset. Basically, we've drilled 50,000 meters, including the infill drilling. And we have 28 million tons of material. This feasibility was based off of 14.6 million tons. So the reality is that if I look at the first 5 years of production for this project, it's kicking off $75 million a year of EBITDA. That is extremely lucrative on a project that we have now a capex of 164 million, which we believe will bring down. So what we need to do is build the back end, the last 5 years or an additional 5 years. And we believe that probably, well before the construction is completed, we will have the addition of of another 5 years of the same type of materials. But many people will take the route, and some of our competitors out there have taken the route that they're just going to go and explore and drill. We are operators. We are developers. We like to build things. We like to generate cash. And so what we decided is that let's go and bring this thing to fruition as quickly as possible. We again have a high degree of comfort that this project at 39% IRR is going to meet any criteria required. And then any benefit that we have will be ancillary. But I would say that there aren't many projects in the world that I see today with current CapEx and OpEx numbers that are running an IRR post-tax of 39%. So
No, fair point. Fair point. Okay, and like 55 is what maybe people's heads were at, but 39 is still a pretty good number. It's hardly marginal. Can you talk to me a little bit more about some of these optimization features? Talk about doing an update of the feasibility study. You wouldn't do that if you didn't think you could shave costs, because that would not be a good message to come back to market.
Yeah, well,
so where's it coming from?
Yeah, well, I think one of the things that we found very late in the cycle through our metallurgy that I think can probably add, somewhere, $15 to $20 million bioleaching our precious metal product. With regard to in the transition zone, for example, we get very little credit we get no credit for our gold and silver. Through the bioleaching process that we've been working with Grinding Solutions out of the UK, basically there's a possibility that we'll recover 81% of the gold in that transition zone. I mean, that'll have an immediate impact as soon as we can bring that in, and we're highly confident we can bring that in. This is why I mentioned it to you. So that's one example. And there are multitudes, but and you'll see that in the feasibility study, which will actually be published today. So you'll see the actual report coming out today. Will be the fact that we're also looking at other opportunities in the opportunities register, but that'll probably be the most significant as it relates to any individual aspect. The biggest conceptual change this project will have is using optimization software and very sophisticated algorithms to drive our mine sequencing and life of mine plan.
What's that mean? What do you mean? What does that actually mean in terms of?
Well, okay. What I was saying to you previously is basically, what we have is we have 2 or 3 domains in the north zone, 2 or 3 domains, 4 domains in the south zone, all with with different metals. As I mentioned to you previously, we're going to be selling 3 cons, lead, copper, and zinc. We're going to sell doré. We're going to sell tin. So within those domains, you have mine sequencing, which is not being fully optimized. And basically the optimization softwares that we see common in the market, used in the market right now, is good, but it's not exceptional. And so even to the point where, if we were to increase our production from, say, 1.2 million tons, which is per annum where the study is now, up to 1.4, 1.6, all of a sudden you're going to see, and if we can utilize the same CapEx, which we believe is a possibility, then all of a sudden you're going to see that going directly to the bottom line. And then, so that's the first element. And so just the general, okay, when are you pulling which material from where, at the right time? And so, what we've opted for now is to go into the south zone, in the second or third year. We don't know if that's the best time. We have software that suggests it is, but we believe that we can optimize that much better.
So in terms of these algorithms and sophisticated sequencing and so forth, again, I point to your company sites. You've gone and got a consultant who's selling this software and saying this can solve all your problems. I don't understand why. It's not going to solve all.
We're not looking at to solve all our problems. But what I'm trying to highlight the fact is that, because of our time constraint, we went from 2 million tons to 1.2. And the reality is that we don't know that it shouldn't be 1.6. So that's a pretty big game changer right away. Okay. And then the second thing is that, and probably I think more importantly is that if you look at how and where we're mining in our sequencing is critical, particularly with such a sophisticated deposit. If we look at Brazil, for example, it's an open pit deposit and fairly straightforward. And there's optimization software for open pit deposits, which are being used, for the last 30, 40 years, which is pretty common, right? But in terms of, and that's just a natural, what is now becoming a given optimization software for open pit deposits. We believe we have access to software which is like that software but turbocharged, and we think that we can really, and it's common use. It's commonly used, and it's been used by names that you would know. I don't want to put out any names right now, but at the same point, we believe that it'll have the possibility of increasing our optimization by 30%.
Okay, so
when you're moving tonnage,
yeah. I say on so that on the so you kind of focus on the optimization and the sequencing and kind of
metallurgy as well.
1.2 to 1%. Exactly. Metallurgy and recoveries, I guess, is another big
critical as well.
You've tipped your hat towards that. In terms of the other side of that coin, which is obviously, you increase revenues, great. The next bit's a little bit harder, which is obviously inbound costs. So is there anything that you're looking at there and you think, if we design this differently, we can eradicate parts of this cost structure? I mean, because inbound costs you're not really in control of, but
again, as part of the factor that we're not, we're not comfortable that we have the optimal sequencing and mine plan. That therefore derives the fact that we're not comfortable that we have the right fleet size. We don't know if it's being optimized, so we can see capex being reduced through fleet size. We have done a pretty good job in terms of bringing down our capex as much as we can, and so I think you'll see, on the capex side, we're at 164 right now. If we bring it down to 140 to 150, that's probably the best we're going to get to, right? So it's not going to be purely the capex. It really is mostly going to be driven by the OPEX.
Okay, it's interesting because I always think that you always look at these companies in terms of a return on capital invested to kind of work out, are they doing things intelligently? There's a smart use of shareholders' money, etc. And you've got to get that balance between the quantum of the money, what it's going to do for you, and what it's going to generate for you over a set time frame. Are you conscious, therefore, in a market like this where whatever companies do, they're not getting rewarded? You put out you spend a lot of time, money, and effort on putting out a feasibility study and not getting necessarily rewarded for that. You're making announcements. And I say you, companies.
No, for sure. For sure.
So does that kind of drive some of the decision making in terms of like, crikey, we need to do or say something which is going to reflect in the share price versus like we're confident
I don't
as mine builders.
I mean,
to get this thing done.
Internally, our viewpoint is that I think the markets have been fractured and been broken, in my words, for the last year and a half. I do not think that companies, even when they do things great, if we would have had 250 million NPV, do I think it would have changed the stock price? No, I really don't. I just don't think that in the market we have today, that value is being truly reflected. And what's most important there is that even if you were to take a path where you do everything 100% right, and you spend $50 million to create a value of $300 million, you run the risk in this market of not getting that $50 million value. So it's a market that's illiquid. There's disinterest. The participants have all gone away. So I'm not going to blame the market in the sense of our progress. Yes, the feasibility could have been better. We hoped it to be better, but it's still a very, very good feasibility study. Lots of people would love to have a project with a 39% IRR, exactly where we are. And what I would say to you is that, this is still a discovery asset. We've done only 50,000 meters of drilling to recover a 28 million ton resource. Much now 15 million tons of that in the measured indicated in a proven probable status. So the reality is that, as a starting point, this is a great starting point. But we haven't been relying on the markets. You'll see that our last funding actually came from streaming. We had Sprott came in for a $15 million stream that enabled us to complete the feasibility study. So we've really tried to avoid the market at all costs because the market is the most expensive form of capital that we see out there.
Okay.
And so,
no, I was about to say, sorry, there's a couple of things I want to talk about. One is you made a good point there. If you come back with a NPV8 of 250 million, people would not have given you credit for it. You come back at just below 150 million for a $20 million market cap company enterprise value. I don't know. Can you explain what you think investors should be putting value against, right? Because it's clearly not being reflected, you would argue, in your enterprise value. But what should they be looking? What is important?
Well, there are two things that I think are still driving market companies right now. And the first one is actually the exploration, right? There have been probably 3 or 4, maybe 5 companies that have done exceptional and have had exceptional exploration results. And are they lucky? Are they good? Who knows? It doesn't matter. They've done exceptionally well, and they've been able to, with the drill bit, to create outsized gains. And that's what everybody's kind of looking for: world-class deposits that they can get very rapid returns on in terms of through the drill bit. So that's the first one. The second one, and I'll use companies like Rupert and Great Bear as examples there. And they've done very well, and they're smart management teams, and good for them. The second one is people driving cash flow. And I look out in Vancouver, and I look at Artemis with Steve Dean. He's been given a lot of value on the basis that he's creating value, and he's bringing that cash flow in. So he's funded, he's under construction, and he's done a great job doing it on time, on budget, so far. So the reality is that, what do I think, if I'm an investor, and I look at what Ascendant has done, am I convinced in this market climate that we're in that the market's going to give me value for this feasibility study? Probably not, unfortunately. In other markets, we probably would have got value. But that's where we are today. And so what would I say are going to be the triggers for growth? I think it probably in the short term won't be the drill bit, for the next 3 to 6 months, because we're going to focus on bringing this to production. But I think what you'll see is probably within the next, we've already announced that we have the UK government providing us with 70% of project finance. We'll probably announce within.
Is that conditional?
Everything's conditional, right? So due diligence, and they've already done. They provided us with a what we call a compliant expression of interest, which means they've already taken a look at the project, and subject to it being according to our metrics and their metrics, then it's all fine. Then they'll proceed. But what'll happen next is we'll engage a bank who'll work on behalf of this group. And that bank will do the due diligence that's required for the Export Credit Agency. And I think at some point we'll get what's called a long form term sheet. We'll get a short term sheet probably between now and mid-September. And that'll probably drive the approximations of the deal. But probably, early in the new year, we'll get the long form term sheet, which is post diligence and only requires the paperwork to be completed. When we start showing that we have paperwork, to be completed only on the project funding, given the fact that we have a expression of interest from streamer, and given the fact that we will probably around that proximal time, we'll have some form of offtake. I think at that point this project looks very real. And if you look at the peer group, I mean, even today, the peer group trades at 0.5 to 0.6 times NPV. I see no reason why this project shouldn't trade at that value. And that would give you a market value of on a US dollar basis of 75 million at 0.5, which is what, $120 million, 75 would be about 105, 110 million US Canadian, which would give us $1 a share. Well, from 15 cents a share where we are today, that's a pretty good return.
Yeah, but like I say, vagaries of the market, etc. Let's focus on things we sort of understand, and we'll see whether the market gives you that credit at the end of the year. You've got to do an updated feasibility study by the end of the year. Presumably, this isn't starting from scratch, as most of it you've done. So this is optimization of certain components of the feasibility study, which will cost what?
Oh, I think $1 million, if that.
Oh, right. Okay. No big deal. And so you're sitting on how much cash? Remind me.
Cash right now is tight, but we're working on a number of different initiatives to non-dilutive to get us on side.
Right. And do you feel that you can obviously, with Sprott in there as well, you've got to be conscious of not giving away too much of the future upside of this thing. With regards to one of the factors that I was surprised you didn't mention there in terms of what people should be looking at is that surely like near-term producer would be
well, that's my point. I mean,
right?
Near-term cash flow we'll be first of all, we'll be one of the the only new companies on the Pyrite Belt looking to come to production. We'll be one of the few companies, in a long time that's brought new production into the Pyrite Belt, which is a very prolific belt, as you know. So the reality, we'll be driving, as I mentioned earlier, we'll be driving 75 million of EBITDA, probably starting in the third quarter of 2025. The reality is that's a pretty nice return for a company with a 20 million market cap.
Those Romans,
we have to get there. We have a lot of bridges to cross, but it's pretty attractive.
Those Romans knew a thing or two, didn't they? If we talk about in terms of permission, it's Europe, okay? So Europe's not an easy place to mine. So underground's better than open pit. License, not in my backyard is a big thing there. So in terms of licenses outstanding or permits outstanding, where do you sit?
Well, I'll say first of all, we are a project of national interest. We are the first mining company in the history of Portugal to be awarded a project of national interest for a greenfield project. All other projects of national interest are infrastructure or they're tourist driven. We have the strong support of the Portuguese government, the Secretary of State, the mining agencies, the economic agencies. This is a very, very important project for them. It's underground, as you mentioned. People will know this mine site only by two things. One is the sign outside the door, and two, you'll see probably 4 trucks an hour going to the highway, which is 4 kilometers away and bypasses the town. So otherwise, we're going to be in a self-contained area, which is a forest with trees all around us, and nobody will know that mine site is there. So in order to get your status of national interest, basically what has to happen is you have to have the local support. You have to have the environmental preview completed, and again, it's got to be a strong economic contributor. So the reality is that we do not see any issues as it relates to our permitting. We expect to file our revised environmental impact study by late September. We expect to see our recaf by the end of the year. And then we expect to see the construction permit issued by the end of March.
Right. Okay. And in terms of, I'm trying to think of the things that I'd need to believe. So in terms of metal prices, some are doing better than others. You're predominantly zinc lead.
Well, we are a true polymetallic. I mean, basically we're 30% zinc. We're about 20 to 25% lead. 15% copper and about 30% gold and silver.
Right. Okay. But lead and zinc is where you're at. But in terms of value in the market, because obviously zinc's had a sort of up and down time the past couple of years as well. But in terms of payables, the value sits where? Which of those commodities is working for you best?
Probably the gold and silver, and particularly if we can add this bioleaching in now, that'll have a very material impact.
You mentioned that earlier. I mean, bioleaching is probably new phrase to some. So can you just explain why that's good?
Well, basically, it's just we have had problems in terms of processing material in the transition. And frankly, this is kind of hot off the press. We basically have got this news in the last couple of days, and we're working with Grinding Solutions out of London, out of Cornwall, out of the UK. They've got extensive experience on the Pyrite Belt. And in terms of the actual details, I don't know the actual way that it works, to be very candid with you. But basically what you're using is enzymes to process material that otherwise is difficult to process. I don't know the absolute steps, et cetera, but it's looking very promising, and thus we need to investigate it. And they've managed to what I'd call it, hopefully a breakthrough, where they're very confident to say to us, listen, we think this is a very real opportunity.
Okay, yeah, so we're talking about biohydrometallurgy. Interactions between microbes and minerals is what we're talking about there, folks. And perhaps I think we've done something about it in our kind of the con series, which we'll put a link to here. Okay, all good stuff. Okay, so look, Mark, I appreciate you coming on and sort of explaining what's going on there, and how you're kind of managing all of the moving parts, all the variables there. So in terms of the next 6 months, okay, obviously working towards feasibility study is going to cost less than $1 million. So that's all kind of good news, and maybe a little bit more news on non-dilutive financing. What else are we looking at in terms of judging how you're getting on?
Well, I think hopefully we'll be able to get the drill bit turning again, because that's critical. Even one thing I'll mention, and people who followed the story will see that even when we were doing infill drilling, we were discovering opportunities that we didn't anticipate. And as a consequence, for example, in the North Zone, we see a northward plunge where we see a very high grade copper that we think we can look to exploit. It needs more drilling. We have an offset to the west of both the North Zone and the South Zone that looks like a continuum. And so from that perspective, if we can get a little bit of progress on the drilling, I think that would be very helpful. It will not come into a new feasibility. It won't be there in time. But again, I think in terms of the sequencing and life of mine, that is the most critical element that you'll see in terms of bringing. It's not just 1 point or 2 points. It's just a holistic perspective of the whole mine.